How much are we going to learn from the Fed minutes this week about that pivot?
I think a great deal, because if you see what happened from December to the Jan meeting, there was a significant shift from the Fed reaction function. You know, the data, we didn't have a lot of data. There were clearly some downside risks, but these downside risks, I think, existed in December as well. And yet you had the Fed, so certainly at the Jan meeting, but we also had significant Fed speak that suggested that, number one, they're concerned about the tightening in financial conditions. Number two, that they're concerned about the downside risks. Number three, they're concerned about the balance sheet. And so I'm really going to be interested in what changed in the Fed's mind on the balance sheet front. You know, in December, they were talking about autopilot on the balance sheet to now potentially ending this year. So I think to try and understand from the Fed, is it just a risk management approach, or is it something else? Are they seeing something in the data that's making them nervous?
Well, I'm curious, you talk about that. So you've just given me a list of kind of US reasons why potentially there could be a problem for the economy. I'm just wondering, the Fed theoretically is the US's central bank, but it obviously, as we all know, it acts as the global central bank. Was it external concerns you think they may be more worried about, or internal concerns?
I think, that's a very fair point. One of the biggest downside risks for the U.S. economy is global growth slowdown. I think the Fed will not directly just mention global growth, but to the extent that global growth slowdown starts to affect the U.S., they are congressionally mandated to look at U.S. Employment picture as well as inflation. To the extent that global growth slowdown starts to impact the U.S., I think the Fed will be concerned. So I think you will see a mention around the global growth front. Certainly China. I think Europe is a much bigger concern here as well, because the ECB is trying to normalize. I'm not sure that the economy is actually going to let them normalize, but I think all of that, as it feeds into the U.S. economic outlook, is what the Fed's going to be concerned about.
Do you think the Fed is going to talk about the trade narrative as well? What are we going to learn from the sort of the monetary policy point of view about what is happening on the trade narrative? Because clearly this is having an impact globally. We've seen it, as we've already discussed, in Europe. There's the China factor as well. But how do you think that is playing out in the US?
So I think it's extremely politically charged. So for the Fed to say that the trade issue is a definite negative, I think is much harder for them. It's already, in all my years following the Fed, I think this is the most politicized environment that I've seen. So I think the Fed will be very careful to say that trade is not necessarily a negative, but there's significant trade uncertainty. Is that impacting ISMs? Is that impacting business confidence? I think they'll couch it in that format, but talk about uncertainty. If the trade talks result in a reduction in tariffs, and the Fed has said that that's actually pretty positive for growth. It looks highly unlikely, but to the extent that the trade talks end up in a neutral scenario, I think the Fed doesn't want to extrapolate too much from what's happening right now, but highlight it as its uncertainty. It's a time when we actually needed the handoff from the fiscal stimulus to the corporate sector, and that doesn't happen if there's significant uncertainty on the trade front. So I think they'll couch it more as uncertainty. We don't know, hence patience.
Priya, how long do you think the economic cycle is now going to be? The Fed has hit the pause button. What impact does that have in terms of the cyclicality of the story?
I think it's a fair point. This is a pretty long cycle already, and so the question is, are we near the end of the cycle? I think we can all agree that we're near the end of the cycle. We don't see, or rather, our economics team doesn't see that the cycle's ending just yet. So we still see a few more years of expansion, because this has been a pretty subpar recovery. We haven't had that big V-shaped recovery in order to result in a slowdown now. But I think the big question is, you've got these downside risks, and if central banks, and this is where I think it's key, we've actually moved from a Fed policy mistake narrative, which was at the end of last year, to now the Fed acknowledging the downside risk. I think that's pretty key, because if the Fed and other central banks can keep financial conditions still somewhat easy, I think it allows growth to continue a little bit longer. If instead the Fed's going to let the balance sheet run off and continue to hike beyond neutral, and the ECB also starts hiking, I think then we have a significant risk here of a recession.
Priya, do you think the Fed also was spooked by what was happening in the credit markets?
Absolutely, yes. I think the fact that default rates are still pretty low, and yet you had sort of, widespread widening in credit spreads, and the fact that it was, I'd say not only were the weaker credits impacted, triple Bs were pretty impacted, single As were impacted. That tells you that there was something else going on. It wasn't just a fear about slowdown in growth. I think it was a widespread credit spread widening. It was a classic flight to quality. I think it got exacerbated complicated by liquidity as well. I'm extremely concerned about all the inflows into the credit market, ETFs, etc. And when you're trying to get out the door, if the liquidity is not there on the sell side, which I don't think it's there because of the regulatory environment, I think that exacerbates spread widening. So the tightening in financial conditions, particularly when it comes to credit, I think is a growth concern, because does it mean that now companies cannot refinance debt? And then do you start creating a credit crunch, which then can become your recession indicator? So I think more than the equity move, it was really the credit move in the last couple of months of last year that spooked the Fed. They certainly highlighted it as a financial conditions aspect. But I think the interesting dichotomy will come now. Credit spreads have compressed significantly. Growth is slowing down, but we're not looking at recession. When does the Fed feel like they need to hike once more? And can they communicate it to just being one more, or is it continuation of the cycle? And then do we get a repeat of what happened late last year? I think that's the challenge they're going to have.
Just one final quick question when it comes to the Fed. There doesn't seem to be much US inflation right now. Is inflation going higher or lower from here? And which is the best metric to judge that from?
That's a tough one. So there are lots of metrics. I mean, I think the market tends to look at PCE, CPI for that. I also look at average hourly earnings or employment cost index. So some measure of wage inflation, because ultimately, if you're getting wage inflation, then you start seeing inflation in service sector, because those do tend to be pretty well correlated. So if we I'd say on that front, we have seen a little bit of pickup in wage inflation. So if we continue to see average hourly earnings get to 3.5, the Fed, I think, will get a little bit more comfort that the labor market is indeed tight, that we are seeing wage pressures. That ultimately should translate into PCE. But you're right, inflation in all of the other metrics, so PCE, CPI has been sort of, hanging around below that 2% level. The Fed's actually been telling us they're okay with overshooting a little bit. But I think you'd have to see a combination of wage inflation, some pressure on inflation. And on that front, I would say globally, at least our analysis suggests that the global factor for inflation in the US is actually very high. So unless you see global growth pick up or global inflation pick up, and tariffs is not going to give you that, that's a one-time shock. It needs to be true pricing power for corporates. If that comes back globally, then I think we do start seeing inflation. Our thought is that that's going to be a long way off. I think we'll see the pressures on wage inflation before we see inflation, and that'll actually allow the Fed to hike maybe one more time and then actually end the cycle.